Good morning, everybody. Uneducated Economist here. So let me get the old dice up there because I know how much you need the numbers. All right. So had a request to do a video talking about what's going on with this Treasury liquidity injection that's going to be taking place over the next couple of months, or at least the threat of a liquidity injection coming from the Treasury. And this one's a really complicated one to try and understand. It would be helpful to know about the repo market, like the repo madness that took place back in September of 2019. If you kind of understood what happened then, it would make it a lot easier to understand what's going on now, or at least the idea of what could take place here coming into the future, because it hasn't taken place yet. It's the credible threat of it taking place right now that they are using to try and guide the markets. Now, this is what's going on. Let's step back a little ways, go back to September of 2019. I think it was September. Isn't that right? 2019? Gosh, time flies so fast. Okay. What happened is that, or at least according to the narrative out there that is stated, the banks had a major liquidity drawdown, like the cash in the system. Banks can hold a couple of things on their balance sheet. The two things they really like to hold are treasuries and cash. Treasuries are almost as good as cash. They can be used like cash, but at times they are not cash. They need cash. Cash is the collateral for loans. Okay, so there is times where they need cash, but there is times when they can hold reserves that are treasuries. And it's just kind of good to understand that they can have these two things on their balance sheet and kind of count them as the same thing, but at times cash is needed and not treasuries. So it's important to understand that part of it. And it's kind of simplified on it, but that's ultimately what's going on there. And now what happened back in September of 2019 is that the government had been spending a lot of money. And when they spend money, that means they're selling treasuries. And when they sell treasuries, there are primary dealers out there who buy treasuries. Those primary dealers are the big banks. They were flooded with treasuries and not a lot of cash. At that exact time, during September of 2019, there was a major tax payment, a corporate tax payment that caused a bunch of the cash from these big banks to leave the big banks and go to the Treasury. Now, what's happening there is it's not really going anywhere. It's all at the Federal Reserve. But it goes from the bank's accounts at the Federal Reserve, and they take that money and they put it over at the Treasury General Account, or the Treasury General Account. And that's where it ends up sitting at. And that's where it's been for, pretty much since that has taken place. Now, since then, and this is where it starts to get complicated. Since then, the Treasury and the Federal Reserve had set up lending facilities because in March of 2020, we had the whole pandemic and recession and everything else kicking in, and the economy was going to hell. So what they did is they created these lending facilities to backstop pretty much every corner of the financial market. If there was a loan to be made, they had a financial institution willing to buy that loan. And that added the confidence to the market to continue to, function as if everything was normal. And really, it worked. They had the PPP in there. They had the corporate debt lending facility, which really didn't buy a whole lot of corporate debt. That was a credible threat. They bought a little bit of corporate debt, but really the whole idea behind that was to get the markets to believe that they would be buying it so that they would try and front run the Fed, and it worked great. So these lending facilities had come to an end. These things were only meant to last so long. In fact, they extended them a few times to continue operation of them, but they eventually shut them down, and there was hundreds of billions of dollars these things were funded with. That money went back to the Treasury. So now the Treasury General Account has swelled to like $1.6 trillion. They have all this cash sitting at the Treasury. And they're saying, well, we don't really need this much cash or want this much cash sitting at the Treasury. They're going to deploy that into the economy. And then what they are saying is that they want to relinquish some of this liquidity at a little every month. Not a little, I guess it would be a lot every month for the next 4 or 5 months until the end of June. And they want to take that 1.6 trillion down to about 500 billion, if I remember right. And so something, somewhere around $1 trillion, just under $1 trillion, or just over $1 trillion, I can't remember exactly, but it's somewhere around that mark that they want to inject back into the system. Okay, seems like a good idea. So this is basically like the reverse of the repo. But think about what happened during the repo madness. When all of a sudden there wasn't enough liquidity, cash in the system, the interest rates started to spike as people were in desperate need of this cash to operate business. So they were willing to pay any price, and they went to the markets, and the markets were like, hey, it's way up here because there's not enough cash available. So what happens if it starts working the opposite way? So if a bunch of drawdown from liquidity went to the Fed or went to the Treasury, and now the Treasury is going to do the exact opposite, interest rates would start to come down as this liquidity is starting to fill the markets again. And this is where the major concern starts to take place, is because really us down here, like in the working class, don't really feel much of the effects of it. I mean, the availability of a loan might, change, or the interest rate might change a little bit on some of this stuff, but our day-to-day lives really aren't affected by this. This is more of a banking level kind of thing taking place. But if you think about what could happen to money markets accounts, because if this flooded liquidity starts coming in and the interest rates start to come down, the money markets are already sitting in a very precarious position in which they are just not profitable to even manage. Like the managers who take care of these money market funds are like, man, these things are annoying. They don't profit us anything. It's really hard to keep these things going, considering that we're almost operating at a loss due to the low interest rates that are attached to this. So if interest rates drop even farther, it could cause these money markets to just pretty much freeze up. Like the managers wouldn't want to operate with them. Why would you want to put money in a money market account that has a negative interest rate to it? This is a scary position because money markets accounts is where all lending begins. It's like the start of lending. Like you have the banking level, and then you get into the economy and start dealing with the real people out there. That's where the money markets really have their plays, because that's like the beginning of funding right there. And if those freeze up, everything else starts to freeze up after that. So there's a major issue with that coming up. So now that's what I would think would be like the major concern, is that these money market accounts will all of a sudden become a position in which they are just not profitable for anybody to operate in, and the freezing begins to start. Now that's my concern. I don't know if anybody else out there feels that way, but that's the way I kind of would feel about it. And I would think that this flood of liquidity coming in and these ultra low interest rates, and anybody desperate to try and get the money out there and try and find anything, causing these yields to come down, would even feed the zombies even more as this liquidity tries to find anywhere. Stocks and bonds would continue to rise. The irrational exuberance would begin to unfold even greater. I don't see that taking place. What I see would happen as this flood of liquidity comes in is that the Federal Reserve would have to start raising interest rates. Interest rates on the interest on excess reserves that are held at the Federal Reserve, and the interest rates on the overnight repo. These two things rising together would combat the liquidity injections coming from the Treasury. All that stuff is really complicated. And to try and understand that from like zero, with no understanding of it, is going to be very difficult. I know that. And a lot of this is just an opinion, because the Treasury hasn't done anything yet. And in fact, one of their favorite tools is this credible threat. So this could be just a credible threat that they will be having this liquidity injection coming into the future. They may even start to do a little bit of it. But it doesn't necessarily mean that they are going to go the whole way and inject all $1 trillion or whatever it is that they have, that $900 billion. That's not necessarily what they will do. It is what the markets will be convinced that they will do, and that in turn will cause the markets to do things that the Fed is expecting them to do. Anyhow, that's my opinion on what's going on with that liquidity injection coming from the Treasury. My personal opinion is that the Treasury should take that money, and buy their own bonds back and relieve some of the debt. But that's just me personally. That would definitely cause interest rates to rise, or I mean, it would cause the interest rates to fall and rise at the same time in many ways. And what I guess I mean by that is that as the demand for like safe haven liquidity or safe haven places to be. So this is where it gets really, for the same reasons, like you could see interest rates kind of moving in opposite directions with the short-term treasuries and the long-term, or the short-term treasury bills and the long-term treasury bonds. You could see the same thing start to happen inside of the economy as well. So ultimately what happened is that people were very nervous about their money being tied up for a long time. And so they didn't want to get into that long-term treasuries, which was causing the interest rates, the yields on the treasuries on the long term to rise. But since they needed to go somewhere, they went into the short term, which is causing the short term yields to drop. So they had this separation taking place, this widening of that yield curve. And it was because of the nervousness that came from the investors. We saw interest rates working in opposite directions. And this can take place for a while during that transition. And that's why you can see like some things that are like just don't make sense in the market anymore as this transition takes place, as the markets are fearful of where they need to put their money. And so instead of putting it in where they think it's going to be losing, they put it in some place where they think they can at least be safe for a short term. And then the opposite rolls around. I know all that stuff is really complicated, and I probably didn't make a whole lot of sense on a lot of it, but that was my take on it, and I really don't have anything else to add to it. So, all right, Uneducated Economist, you guys let me know.